Today we are going to look at the top 10 reasons why we are going to have another housing crash and crisis. Today we're going to talk about reasons number 8 and reasons number 7 in the series that I'm doing. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. As I mentioned, Randy Patrick here. This is a playlist that I've created. This is the second installment, and I'll be very upfront. I actually started this back in the fall, so if you'd like, you can take a look at, since I made this a playlist now, you can take a look at Reasons 10 and Reasons 9 if you haven't seen it before, or if you want to refresh yourself, because they're still the same reasons. But to be quite upfront, why I hesitated with this is because every day something is changing within the real estate market. We've had such a ride over the past, year plus. It's been ridiculous. There's, every day there's news articles, news items, things happening in the industry that really, you got to make you think. And it's almost like things are changing on a daily basis. And it's really tough to draw a line in the sand. So I kind of did that. I said, you know what? Because we're at what I call that inflection point, the changing point right now with forbearance, the end of forbearance approaching. So I thought now is the right time to review this and take a look at what's going on in the industry and to talk about this type of stuff. So this will be a longer video. These series will be longer. So please keep that in mind. Put me on 1.5, speed, play, whatever you want to do. But just realize that, we're going to go into some detail here, and that's the sort of reason why we're doing this. So that is the scoop. So let's get into it right now and realize that these are my ideas, my opinion, things that I think are going to happen or are contributing. And I guess, when you take a look at the housing, bubble we're in right now, and then potentially having a housing crash and crisis, it's not one reason or one thing that's going to change the landscape of real estate across the nation. It's a combination of a number of things that are happening, that's why I'm doing a top 10 list. There's actually more than 10, we'll call it reasons or influencers to the situation we're in right now. And of course, for every person who says, yeah, we're going to have a housing crash, there are those who say, no, we're not going to have a housing crash and everything is good. So, it's give and take here. And as far as I'm concerned, everyone's entitled to their opinion. There are certain talking heads out there that vehemently, I guess you could say, dispute what us, people on this side, the housing sort of crash or issue, people are talking about. And that's I guess, the joy of putting stuff on the internet, and we're all entitled to our opinions. So there you go. So the last video in the series, and again, go back and take a look at it if you've forgotten or have never seen it. The last video in the series, my number 10 reason was banks, lenders, and servicers, servicing companies are preparing for an onslaught in distressed properties, which is really foreclosure, short sales, loss mitigation, the whole bit. That was one of the reasons why. So you can listen to that part of the video. And then number 9, which is called, same as part of that video, 10 and 9 are one video. The Mortgage Debt Relief Act is back. And what I mean by that is the Mortgage Debt Relief Act was actually on the shelf for a couple of years. It came back. It actually came back prior to COVID. It came back, December of 2019, just around Christmas time. And it's no longer called the Mortgage Debt Relief Act. It's called the QPRI, Qualified Principal Residence Indebtedness. Now, this is actually a positive thing for homeowners if they find themselves underwater and having to do short sales or foreclosures, etc. So the fact that this has come back certainly, to me, is another indicator that somebody somewhere has taken a snapshot and said, okay, we see a lot of distress coming. That's why we're putting some of these things in place. And again, these things were happening. Number 10, number 9 were prior to, I guess, the general public, you and I, actually finding out about COVID, which is sort of February, end of February, March timeframe here. So that's why, obviously, there was some intel flying around before, COVID hit. So this is the situation. That's the 2 that are in the previous video. Okay, so number 8, investors leaving the market. Well, what I mean by that is this. Real estate investors are leaving the market. A lot of them are from international investors, foreign investors, and there's a number of reasons for this, but they all kind of play a part. There is a ton of reduced flight capital and cash out there. What I mean by that is flight capital is, really referred to as money that people are trying to leave or get out of their current country to park someplace else, just so their money's out. Historically, there's been a number of countries that have had those issues, and they've come into North American cities in Canada and primarily in the U.S. Usually it's coastal cities. It's the West Coast. It's Miami, the New Yorks, whatever. And they're buying expensive properties. They're paying cash, and they're actually sort of inflating and fueling the home prices. And that's because they want the money out. So it's kind of like, I want to get it into an asset that I can access in the future and that can't be clawed back. So we're seeing a lot of flight capital being reduced essentially. The U.S. Department of Treasury has also put a lot of scrutiny on these type of transactions. So transactions from foreign investors, transactions being, they're over $1 million that are purchased through LLCs, trusts, things like that. There's an additional layer of scrutiny. And again, the U.S. Treasury is trying to combat money laundering as well. But also, some of what I'm hearing from a lot of people is the fact that it's just too expensive. Like, in other words, when flight capital and money comes in the country, it's number one, maybe the dollar's weaker, so their money goes farther, but still, they're buying because it makes sense. They're buying because it's an investment. And yeah, they might be able to buy more expensive properties, but it's still working out for them. Well, now it's too expensive, so when it's too expensive, it becomes not interesting, and you're going to see those buyers basically retreat. They will most likely come back when we see prices drop. But the whole point is that they're no longer fueling the huge price increases that we used to see in certain markets. Now, those people are, so the international people who are fueling the increases are now being replaced by people who are residents or buying here from the nation. That are so we'll call it landed immigrants, whatever, citizens, landed immigrants, residents of the U.S. here. So that segment is now doing the whole fueling the property increase. So it's interesting how that kind of moves along here. We've seen a reduction in flight capital from places like Asia, particularly China, as well as Canada, South America, European Union. And a lot of it, too, this year has to do with COVID because, for example, why would you purchase a property in the U.S. if there's travel restrictions, which means you're going to buy it, but you can't get at it or can't utilize it as well, too. So that's something to take in mind. As well, some segments, and I'm going to reference the Chinese here, are what I call net sale decreases. So the amount of real estate being purchased by people from China versus what people from China who have property that are selling is actually net negative. So they're actually selling more than they're buying. So it's actually netting the market out negative from that perspective, which I think is interesting. So just realize that, when a lot of times, the foreign investors, again, there's more to this, but foreign investors go, we're not going to play your games, and we know when to get out, and we'll wait when the time is right. Now, domestic investors, now I look at the domestic investors as being the feet on the street, all right? Two segments to this, the pros and the amateurs. The pros are people that typically are buying a lot of property a year, and, we're talking not 4 or 5 deals, we're talking, usually 20, 40, 50, 100, 200 deals a year, primarily single-family homes. And yeah, and you know what, I'm actually not even putting the large institutional investors really in this category because they're really in the category on their own, hedge funds, institutional investors. But the whole idea is the pros approach acquisitions carefully. So in other words, they're already factoring in a future value reduction. So if they're going to buy something and fix and flip and look at ARV, which is after repair value, they're going to temper that and say, well, maybe the ARV might won't be as high, or we'll factor in a reduction or risk factor as well too. They're actually targeting a lot of what we call the C-class neighborhoods, so working class neighborhoods, and the reason being because that's where the rental opportunities are, and that's where the primary first-time home buyers are going to be. So they're not going to the different segments. Yeah, there's some that specialize in higher market segments, but the point is that's what they kind of target, right? So really it is I can sell it to a first-time home buyer or an average home buyer, or I can rent it out. It's going to work either way. So you give yourself the most, I guess you could say, opportunities. Well, it's all about the numbers. And what we see now is from the investor perspective. What I mean by investor perspective, a lot of it is off market, which is what I see and deal with quite a bit, that the numbers are out of control, even on that aspect too. And the pros are not going to buy for the sake of buying. They're not going to acquire just to acquire. They're going to keep with their model, and they're going to acquire as long as the numbers make sense and it proves out. So they're not going to get hyped up in that. And also I can tell you a lot of them, from what they talk about in the media, what I talk to them personally about, what I hear them on webinars and news articles, they fully believe that a foreclosure wave is on the way. A lot of people who fully believe in this were part of or participated in the last housing crisis as well too. That's why a lot of us who did that in the past, you kind of see the signs that are happening. That's why I'm doing this video series. But just so you know that the domestic investors, that the pros are being cautious. They're not buying for the sake of buying and paying the retail market prices. Okay, now the second segment of the domestic investors are the amateurs. And what I'm finding with the amateurs, and again, this could just be newbies, people who just have money they want to burn, whatever. Well, they're buying on emotion. So it's kind of like, got to get this deal, got to jump in now, okay? And when they get it, they're bleeding the equity. So when they want to move on, wholesale it, flip it, whatever you want to call, they're taking a big chunk out, and it's actually making it not effective for that next person, whether it's the end buyer, whether it's a landlord who's going to rent it out, whatever. So they're actually bleeding the equity and making it difficult for that next person. The whole premise on this is FOMO, fear of missing out. So it's kind of like, hey, we better get this now because the market's going up still, and if I strike price here, I can make 20 grand here. So that's going on, as we speak. Now, they're buying anywhere and anything. What I mean by that is I'm seeing different locations. So, for example, I'm in Florida, and I'm seeing stuff hit my desk or via emails or texts or people that call me, for locations that I never would have thought were what's the word I'm looking for? Like, primary investor opportunity locations. So we're seeing movement into, obviously the Orlandos, Tampa, Miami, Lauderdale, Jacksonville's your top markets, here in Fort Myers or in Florida. Now I'm seeing things drop down a bit more. Like, what I mean drop down is they're going to more secondary and tertiary markets, you see. So maybe not as big a city or like maybe it's still a good population, but not the profile one would suggest that, hey, would you buy in Ocala? Nothing wrong with Ocala. Ocala is a great place, but that's not a profile like as, say, an Orlando would be, you see. So they're buying anywhere and anything, which to me shows that inventory is tight. And this is where I always go. This is the number one reason, is that mobile homes are wholesaled now. So the mobile home segment, which is really becoming down here, the new affordable home marketplace, I'm seeing more mobile homes being acquired and being put on the market for flipping or whatever. And typically mobile homes are, if they're older, they're falling apart. They might have some land. They're structurally have some issues, but they're going for a lot of money now too. So maybe when a house goes for 150, 200, 250, mobile homes are going for 75 or 100 now, which really is quite a lot of money. Now there's some land involved occasionally too, but I'm just seeing a lot of distressed mobiles, one-offs being moved, which to me is an indication that we got some stuff going on. So the whole point of this is the fact that the investor pool is pulling back. When the investor pool pulls back, that means market values at a peak. It's not a deal, and there's a risk element there. And the sentiment among many investors is the fact that they're going to wait for stuff to fall apart, to crash, correct, crisis, whatever, before they get back into buying, because they've got the cash. Not an issue here. So anyway, one thing, guys, if you're not already a subscriber, if you could please help my channel grow and subscribe, because I look at my stats and the majority of you guys watching this video are not subscribers. So please smash the subscribe button, help my channel grow. I really appreciate that. And if you think you're a subscriber, could you please hit it anyway and verify, because I've been having a lot of problems with subscribers dropping off, funny business going on, etc. So thank you very much. All right, now let's go forward. Number 7. Well, this is a long title for number 7 here, but the current housing, reason number 7, we're going to have a housing crash or crisis. The current housing narrative and the government's obvious goal to get further involved and control more aspects of the housing market. That is a mouthful. I truly believe this, and there's a number of reasons why. So let's get into it right now. Okay, so what's the current housing narrative? Now, this is how I'm interpreting the narrative. You may interpret it a different way, but I'm looking at a number of different things, and for what I've seen over the past 12, 15 months, is that the government, their obvious goal is to become further involved and control housing. All right, so to me, that's one thing that they're trying to do, is they're trying to get their fingers in the pie. And this is what happens too. When property values rise and things look good, everybody wants to get in and get a piece of the action. Governments are included as well too. So that's kind of my one point there. Secondly, is that mainstream media is so desperately trying to downplay any issue that can affect the housing market. So anything that's potentially negative, or they interpret as negative, they're trying to spin it off with some excuses, etc., and basically say, yeah, but. When I mean that term, it's the yeah, but. Well, there's a lot of people facing foreclosure. Yeah, but we're going to do this. Or yeah, but this is going to happen. So there's a lot of that going on. But for me, I look at it going, it seems that there is such a, it's almost like the more you notice it, the more they're trying, what are they trying to cover up, right? And, the social media platforms don't quite control the housing narratives like maybe political stuff here and there, etc. But it's starting to, and I mean, as I'm hoping you guys read between the lines with my subscribers, my videos, whatever. I certainly know that I've been throttled down, and not because I'm talking about anything that's not visible on the internet or available to be researched or analyzed, etc. It's an opinion that I have, and the fact that I'm not. Please don't. Let me just qualify this. I'm pro housing. I'm pro everyone should have a house and enjoy the house, and that's a goal that everyone should strive for if you want. I'm just not pro paying way too much something that's going to decrease in the future. I'm pro affordable housing, pro enjoy your home and not be paying, again, not paying too much and getting taken advantage of. So that's kind of my sort of position here. So social media will control that. And when I look at the current narrative, so what is the current narrative? And with the situation we're in right now, well, the housing market is strong. So what you're hearing every day is, oh, look, values are up. Case Shiller, Realtor.com, Redfin, all these groups are saying, look, CoreLogic, look, Fannie and Freddie, all the predictions for the future market is we're going to be growing by double digits again. All right. Values are expected to increase. So it's a healthy market. Buy that home today. Why? Because it's going to continue to go up in the near future. And this is being fueled on by record low mortgage interest rates. So yes, and that's sort of where the government does come into play here, right? It's okay to buy because the rates are there. Your buying power has never been better. And oh, by the way, ignore those high prices because we've given you access to low rates. And because you've got access to low rates, the buying power negates the price point. So all we do is we just look at the payment. We just look at what our monthly is. And you almost, hey, as long as I can afford it, I'm okay with the payment. Now, am I paying 50 grand too much for that property? But the payment's okay. 50 grand extra over the course of a 30-year loan, how much additional interest am I paying on that? Doesn't matter because my payment's still effective for me or I can afford that right now. You see? So I think we look at things a little differently and we're being slowly kind of, I won't say the word brainwashed, but coached in the fact that when we have these low rates and prices going up, it's okay. Now that's part of the narrative. There's a couple of components to it. Forbearances are just a bump in the road. So basically, the big narrative, and I heard this on a webinar yesterday, okay, is that forbearances are merely a bump in the road. Everyone in distress will be able to sell their property and everything will be okay. That is the narrative. So all this information, all these millions of people that are in the forbearance program, that the ambiguous number that's forbearance, foreclosure, whatever that number is, which we'll talk about in a future video, don't worry about that. It's not going to affect you. It's not going to affect the marketplace. They will sell their home because of our newfound equity and everything will be okay. That's part of the narrative as well too. So really there's no issues here, guys. So don't worry, go out and buy that home. That is what's being conveyed to the American public, all right? As I mentioned, the huge amount of equity solves the problems, okay? That's the narrative. And, part of this is where the narrative and the government kind of blends in together. The eviction and foreclosure moratorium is for your protection. This was done to protect the environment, to protect the citizens, to protect the renters, to protect the people that are being foreclosed on so people wouldn't be on the street during a pandemic. It's for your protection. That's part of it as well, too. This is not like the last bubble. There are there's typically 2 or 3 reasons why a lot of journalists, when they'll perpetuate this, that, this is not like the last bubble, right? We have better guidelines. We have all this equity. We have all these government programs, etc. So this is not like the last bubble. So don't worry about what happened 10 plus years ago. Don't worry the chaos that was experienced. No one's going to experience what they did back then today. It's all okay. So journalists and other people are perpetuating this through the media. And as I mentioned, you know what? Anyone can substantiate anything. And that's what I've learned. I'm sure we've all learned this over the past 12 months, 15 months since COVID hit. And there's different layers to it as well too. But really, if you say it enough and you say it often enough, people kind of believe it and they kind of accept it and they move on. You see, so it's guys like me that like to keep pointing this out and go, you know what? There are problems here, and if we want to sit here and be complacent, it is going to be this way. And you're never, I'm not saying this sort of in a rude way, but you're never going to buy a property that you're comfortable with because you're always going to feel that you're overpaying for something, right? Because it's not a good deal. I mean, listen, good deal, just cost effective, like affordable, right? I think good deals are long gone. It just boils down to what can people afford without stretching themselves too thin. But as I mentioned, anyone can substantiate anything with respect to, as long as you say it enough, and people will hopefully believe it. Now, one of the things that part about the government getting involved here, well, I've seen over the past couple of years, and obviously this year a lot too, the government getting involved at every level. What I mean by at the federal level, the state level, the local city, the metro, the county level, and they're trying to shape and or influence the housing market throughout the country, throughout your state, throughout where you live locally. All right. So how has this happened? Well, the Fed has kept record low interest rates for quite some time. Quantitative easing came back after the last housing crisis to stimulate the market. All right. And you know what? I actually forgot about something right now. There you go. And hopefully I could talk about it during this component here. And one side step here too. A lot of what I'm saying will cross-pollinate to other videos and other reasons. So things I say now I'll touch on in future because they're so related. But anyway, Fed has kept low interest rates and quantitative easing for a number of years. Okay. FHA is a new subprime. And what do we have with FHA? We have a ton of FHA delinquent loans. Okay. So, is that a good thing for the marketplace? Are they creating their own chaos here? All right. So think about that. The Fed has misread the housing market. And this is according to a lot of economists and analysts in the real estate industry that have said they are not looking at this correctly, that they're using the wrong consumer price index to sort of, to estimate or to calculate housing inflation. The big issue is that they're using a rental type index, which is not indicative of housing sales, and that shouldn't be used. That's the argument there. So again, they've misread the housing market, and this is a larger problem for the overall economy. The Fed continues to purchase mortgage-backed securities. A lot of economists and analysts say there's no reason why they should be doing this in this market. They do it, to keep interest rates low, so it's all self-perpetuating here. And, you might see something in the local news these days about the Fed tapering off on their MBS purchases. They're doing roughly $40 billion a month, apparently. That's a lot going on. So that's beyond my sort of pay scale with regards to having that financial analysis. But again, the people who know this are saying they need to taper this off because it's not helping where things are going. Also, the Fed recently came out, and I don't know whether this was a proposal, because sometimes they propose stuff that doesn't get through, which is fine, but they want to limit and cap the 1031 exchange. And that was a big topic a few weeks ago. The 1031 exchange is, when you have investment property, if you sell an investment property and you buy another one, and there's constraints and process you have to go for, sort of follow through to do this properly. But the 1031 exchange defers taxation because you're taking your proceeds from your sale and putting them into a new real estate venture. So there's a long story that goes along with that. There's ways to really amass a lot of wealth through real estate using the 1031 exchange, and they're looking to bust that out as well too. The limits are really up to $500,000 of profit for, I believe, a married couple, I believe. But what it does, though, it hurts growth. It hurts growth and reinvestment into locations and stuff like that. So it's not positive here. But you can see that they're whether it's to get more of your money or to control, they're starting to actually start to dig into your pockets and control things. Now, at the state and local level, we've seen a lot of Landlord Tenant Act changes going on. So every large city has been changing the way whatever Landlord Tenant Act stuff they have, and it's causing some problems. And what I mean by problems is that they're limiting rental increases. They're making it more difficult to evict. It's just more layers going on here. Capital expenses, stuff like that. So here's the thing: if you can't raise your rent as a landlord, but your insurance goes up and your maintenance costs go up and your taxes go up, well, so what's the point of being a landlord? So you see, I believe that there's a certain target here, and we'll talk more about that. So certain Landlord Tenant Act changes are going on at various levels of government. The additional moratoria layers. So of course this year or last year we started off with FHA or FHFA moratoria on evictions and foreclosure, evictions and sales, whatever. So you had those that came out by the government, and then you had states putting on their own moratoria on top of that. Then you had the CDC adding their own moratoria. So at one point in time, you could be looking at 3 different moratoria on a property, and that's just, that's tough. I mean, how do you as an owner or landlord, etc., navigate all that, which is difficult. So really, it's making life difficult for a certain market segment. What I've seen now too is some at the local end, different moratoria on construction. What I mean by that is some states or counties or jurisdictions have said, hey, now we need housing, we need rental accommodation, we need just units, and they've put a kibosh on some multifamilies being I guess you could say approved. Why? Because they want to study the effect. All right. So local government gets in, and by doing what they think is right for the local, they're just causing a lack of inventory, and more stress on upward pricing. Okay, so that happens at different levels too. I mean, there's tons of examples. People start investigating, local where you are, etc. At the state level, managing the foreclosure process, and I look at this as there's a California bill. It's called SB 1079. That was approved September 2020, went into play January of this year. All right. In a nutshell, look it up. It's kind of interesting. What it does, it's all about the foreclosure auction process. So if an investor wins a foreclosure auction and buys a property as a third-party bidder, they don't get to take possession immediately. All right. There's a time frame where if there's a tenant in the property, the tenant can opt to purchase the property at the same price the investor bought it for. That's number one. And two, an owner-occupant can now jump on top of that and offer more than the investor if they want the property as an owner-occupant. So it's almost like we've had one set of auction, like the true mortgage foreclosure auction that went on, and now we're almost having like these mini kind of auctions behind the scenes in California. So long story short, this is sort of open for shenanigans, out of control here when you start looking at it going, I can see how you can circumvent this and mess around or do whatever. It's number one. And two, does it really solve a problem? I mean, how many tenants, and maybe it's different in certain locations, but, maybe because California prices are so high and if the inventory is low, a tenant could buy this. So I could be wrong. But the whole point is, though, the state's getting involved in trying to allow this. And also, not only owner-occupants and tenants, but nonprofits. So, nonprofits for housing are get first crack at this as well too. So if I'm an investor and I won the foreclosure auction, if someone bids $100 more than me, they could actually win that auction subsequently after the fact, which doesn't make sense. All right. Zoning changes. Now this, so the government gets involved here, and the government's trying to do something positive. What I mean by positive is allow for various zoning changes to increase density in specific neighborhoods. All right. So, but what that does though is that could change neighborhoods. What I mean by that is change the dynamic of the neighborhood, which would in turn possibly reduce property values or cause some changes in the neighborhood demographics. Right now, nothing wrong with demographics, broad speaking, but the whole point is if you have single family homes and you take one lot and you make it multifamily so you can turn it into a triplex, well, what have you done? Right? What have you done? You've now sort of changed the dynamic of that neighborhood, and maybe the two houses adjacent to that triplex are no longer going to be as valued because now you're sitting beside a rental accommodation. All right, so that can go on. So it's more like, hey, governments will just sort of plan these things out and try to do these things and get involved, but maybe not with the true foresight or proper analysis. That's my pointer. So again, we're going to see more of this as time goes on. So just be prepared for it. And if not in my backyard, that's what you hope, right? We saw last year what I'm going to call random housing bills, and some of these housing bills did not get passed. Thankfully, all right, very important. But if you look at some of the stuff, certain segment of the political arena was doing this. You can figure it out on your own here. But a lot of it has to do with taking control away from owners and landlords. All right. So again, government getting involved, government, being generous to other people, but not taking care of the people who are actually taking the risk and putting the money out. So that stuff, a lot of those things didn't pass, but all I know is that there's a framework there. You can see where the end goal is. So they're going to get more involved for sure. Now, the Fed, I think, behind the scenes has basically said the small investor, the small landlord is a target. Why? Well, that small investor and small landlord market segment, you'll know this from other videos I've produced, basically has about 19 million plus units across the country. And these are SFR, single family units 1 to 4, okay? Anything 5 and above is classified commercial. So if you have a quadplex or triplex, it's a single family peg count, so to speak. But 19 million units, a ton of it. Okay. Well, and why are they a target? Well, guess what? You'll see in a minute here. My point is eviction and foreclosure. Well, eviction moratoria. So landlords are getting creamed by this. Okay. Every day we're seeing more and more horror stories going out. I've had clients experience this directly myself, so I've seen it, living it, working through it right now. There's all these stimulus packages. There's two that have been out, I think one in December and one in January or February, and they've earmarked billions of dollars in rental assistance. Well, where is that rental assistance? Don't know. Not very easy to figure it out. How do you get it? Don't know, because there's apparently many, many different programs that can filter from the federal government granting the money, going to the state, going to your locale. So that's the problem. There's many different programs. A lot of it, there is just no incentive for tenants to do this, because in the end, what they're doing is saying to tenants going, hey, get involved in these programs and then you can pay your landlord because we're going to give you the money. Well, you know what? They're not getting the money, so why would they bother doing the program? So people just are, and this is coming from landlords going, my tenant refuses to actually go through the process. My tenant refuses to engage the program. So the money's there, but they just don't care, right? So they don't care because what's in it for them? I can stay here for free. Why should I jump through hoops for my landlord? He can't evict me anyway. You see, so that's going on. And if you're a landlord, there's also conditions to get it. What I mean by that is there are probably different, now this is not across the board. This can be location, state, location by location, and also it can be program by program. So I don't know all these programs. I've dealt with a couple locally in my market. So there are certain conditions for the landlord that may not be that attractive. And one of the conditions is no eviction. So, if we give you some money, you have to agree not to evict that tenant for a year. So now I don't know how that'll stand up in court or whether a judge could block that. But the whole point, though, is that it's another risk. So I'm getting some money, but this could happen again to me. So my any further ahead? Why not just cut my losses now? I've already lost, and you just get a better renter in there, right? So again, this is what we're dealing with. So I truly believe that this really is not well thought out. So once again, the small investor is the target here. It's not the first time, all right? This occurred during the previous housing crisis and crash. I experienced this firsthand. Freddie Mac and other parts of the government attacked us, the small investor, the mom and pop investors, with flipping and short sales and things like that. We're not going to get into it here because it's probably an hour to 2 hour discussion. We created something called the Distressed Property Coalition, the DPC. Some investors joined us. It was funding, it was lobbying and legal up in Washington, D.C. So basically, the whole point, though, is that it's easy to hit the little guy. Why? Because the little guy is the little guy, the little person out there, the mom and pop, the small investor, because it's fragmented, all right? No one is paying to lobby. No one has a voice in Washington. So you can hit the little guy, do what you want, but they ignore the big boys because the big boys are providing the political donations or doing what they need to do, to Wall Street, whatever, to make it easy, right? So this is where the government, part of my reason number 7 here is the government's going to be complicit in this wealth transfer, all right? This next wealth transfer, those 19 million properties are targets, and part of it too is don't forget that what does forbearance cover? Typically covers a what? Primary residence, right? So many of these landlords that have mortgages probably aren't covered by any forbearance program. And in the end, all forbearances, if they are, it's a pause on payments, and they're still going to have to pay for it in the end somewhere. And if the renter assistance doesn't come, then there's no money for them. So you see how this vicious circle actually works. Rules for and regulation for the small investor, anything goes for the large investors. And the reason being, we know that because of what happened during the last housing crisis, how the large investors were able to do all they wanted to behind the scenes and gobble up all the properties, etc. And the rank and file, the small investor, the retail people, we don't get a chance at all that inventory. And that to me is government's complicit in this wealth transfer, and they want that to happen. So realize this. I put this out the other day on my Housing Bubble 2.0 Facebook page, and basically I've got a lot of contacts for different projects here and there in type of real estate. So someone called me and said, I got 31 units in Las Vegas. Do you know anybody? So I made some calls to some investors. I put this out on my Facebook page, and when you take a look at this comment, so I sort of inked out the comment from the person here. It says, 31 units looking for, obviously, someone to buy the whole package, which would normally be an investor. An investor owns this. This is the reason there are so few homes for Americans to buy, settle down, and raise a family in. They are all being turned into rentals by investors, okay? Yes, okay, they are being turned into rentals by investors, but don't blame the investors because they are being enabled by who? The government, okay? That's what it boils down to, because all the restrictions and rules on the small groups, and we want to focus on that, but you'll let the hedge funds buy out of your inventory at a discount, and these properties never come on the market for normal buyers, okay? We can talk days about that. So realize that, yeah, investors are buying a lot of stuff because they can, and that's where the money goes, but they're being allowed to, and they're being encouraged to by the people who control the government. So, all right, guys, so it's time, and what I mean by that is the market's at its breaking point, end of forbearance is approaching, owners are going to start to liquidate because we see that now, investors as well too. Foreclosure auctions are back on track in many locations across the country. We see that foreclosure filings and starts are increasing as well too. This is where you need to look for deals, okay? All these hedge funds, these big investors won't go down to the homeowner to engage. They're going to buy at the auction. They're going to buy behind the scenes non-performing assets and loans, which they still do, in pools of millions and millions of dollars. And that's why we never get to have our hands on those properties. So realize that from the distress level, more will be available than predicted. We're not seeing the true numbers. And people say, well, just how many are distressed? Well, here's the thing. Black Knight focuses on the forbearance numbers. That's all we talk about. The chatter is 2-point-something million. They're actually, I just checked today before doing this video, and we actually had a small increase again in the forbearance. We're at 2.2 million. 2.2 million active in forbearance. All right. Previous webinars I've attended from different data suppliers show that they expect about 3 million plus foreclosed homes on for 2021 to 2025. Today I just saw something on Yahoo via from CNBC. That's the source. Basically saying we got 2.2 million active forbearance. We've got 1.8 million seriously delinquent loans. They're not in a forbearance program. That's 4 million potential issues there. Okay, so that's a number. White House stated that there's 10 million adults in households not paying their mortgage. I kind of debunked that, though. That is 10 million adults in households, not 10 million households. So take a look at what? At 2 million, at 10 million adults with an average of 10 million households with an average of 2 adults per household. That's 5 million, but we know it's probably not a two person ratio to a household, maybe like 1.5, whatever. So that could be up to 6.5 million, whatever it is. I've heard the past couple of weeks, 10 million foreclosure issues, 11 million the other day. So the numbers are starting to increase now as this kind of works its way through. I'm thinking we're going to see 5 to 6.5 million conservatively. That's my number. So there is stuff that's going to happen. I suggest that you guys take a look at this right now. Get prepared for it. It's going to hit us in a different way than before. And of course, my self-promotion here. Short Sale Cash Connection is the premier deal to figure this stuff out. So really, it's a coaching, mentoring, education, deal flow. My attorney does the negotiations. We know how to stop foreclosure auctions, blah, blah, blah. It's multi-layered. It's an awesome program. I'm going to be doing some changes to this very shortly. I've just signed a deal to distribute this on a larger scale, and that's why what I'm offering now is the best price and best value for this right now. So if we've talked before and you've declined, you might want to get back in. If you're interested, drop me a line, and we will go from there, okay? So by the way, if you want to get a hold of me, what is my email? Hang on a sec here. By the way, why do you want to do this stuff? Sorry, I go back to the equity here. Essentially, short sales show you right there, tons of equity if you know what you're doing. So there you go. GetHousingData.com. If you want to look for distressed properties in your area, go to the number one source, which is Foreclosure.com for distressed property listings. Go to GetHousingData.com. Check that out. All the things I talked about, let me know. Connect with me, and we'll engage. I hope to. What my plan is to run these videos throughout the weekend and early into next week to get through my top 10 list and go from there. So everybody, thank you very much for watching. Thanks to the views, likes, comments. Have a great Memorial Day weekend. Please share the video with your family and friends. And once again, if you're not a subscriber, please do me that honor and smash the subscribe button. All right, guys, we'll be talking to you probably tomorrow.